Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, April 15th, 2024. It's 10:23 a.m. Eastern Time. Wanted to get one out to you, and I will keep this one relatively brief. I'm going to just talk about primarily the stock market. That way I'm not all over the place. It doesn't go for 45 minutes or more. No change on the my outlook or the key levels to watch. QQQ 433 is still to me a very significant level. In fact, I've talked about it so much now, and at this point it should be obvious to the masses, where it might not have been so much back here, where there's a lot of other things I'm watching as well. And now, being that it is such a big level, again, it should certainly be 100% bearish unless we see anything but a whipsaw, meaning a false breakdown, and then followed by a recovery back up into, especially well to the top of the range. But that's a level to watch. A 50-day moving average. Again, been harping on forever. We've been in that trading range, and as I say, I'm like a lot of things up. I call them yogiisms, and one of them is, patience. And life, if patience is a virtue, it's an absolute must in trading and investing, and even swing trading. Swing trading is kind of like investing on fast forward. We're in and out typically in a matter of weeks, sometimes months, even sometimes just days or hours, depending on the trade setup. Whereas investing is, things you're putting in for years. But that level, I just want to reiterate, is no less important to me than it was when I started talking about it back here. In fact, the fact that we've tested it several times and held, and it's additionally validated, like I just said, more eyes watching it makes it even more important. As is the top of the range. This is a big, fat, sideways trading range that a blind man can see. It's so obvious. So take it for what it's worth, And I even gave you today, and I've been talking about it recently, if I zoom down, step down to the 60-minute chart, kind of my trading plan, and where I think, we can certainly go to the top of the range again. If we do, is that an objective short? Absolutely. Anytime you rally into resistance, TA 101 says you do one of two things. If you're bullish, you wait for a breakout above the resistance. And if you're bearish, you short a rally into resistance. However, like I said, based on where we're at, I think we have the market on the ropes here. And as what I was kind of going before, where 433 is still important, but we've had quite a bit additional check marks. Remember, it's not the be all end all. It's one big level I've been talking about for weeks. But I've also talked about the S&P 500 sectors, mainly the top four. I even went so far as to say some of the sectors in the S&P 500, like energy and basic materials, well, that's actually bearish to see them rallying, even though it contributes to the S&P 500 because they are, indicative of inflation trade. Basic materials, lumber and concrete and steel and things like that. Aluminum, and then of course you have energy. We all know what's going on there. Okay, so that's that, and I gave you kind of micro levels today. I'll get to those in 1 second. There was NQ. You can extrapolate those levels on QQQ, or you can go to any of my recent charts. Go to the recent videos. Here's the 15-minute chart. So this morning when we were at resistance on NQ, it takes a long time to mark up all these charts. Every index, SPY, IWM. So sometimes I'll get out what I'm trading, what I'm watching. And I like NQ, not just because it's my preferred trading proxy versus QQQ, at least in, in my primary active trading account. But it has additional levels because it trades, when you're looking at the NQ futures, you're looking at 24/7 trades. So we're going around the clock Monday through Friday, or Sunday night through Friday evening. And so you're going to see more reactions, more levels. It's the support and resistance levels that may not be visible or easily apparent on the QQQ chart. And that is why I get that out there. Even if you don't trade futures, there's free futures charts everywhere. If you have a Schwab account, which used to be TD Ameritrade, Thinkorswim platform will give you them free real-time, investing.com, free real-time futures. A lot of places you can get them without even having to pay for the data on that. But there it is, guys. That was 442.26. You can see it was nice. Support there. That was the level I had. Reactions there. Boom. And that was the last major reaction. It was the top of a gap. In fact, that's all they did this morning. Futures ran up. And QQQ opened to make a perfect backfill of this gap right here. I'm sorry, back test. There's the gap. There's where we open. That was a a very objective shorting entry, and that's why I fired that one off to you right at the open today via NQ. So those are levels. Oh, and going on to as I said, we can I give you my preferred. It's solid arrows always my preferred scenario, whereas those dashed arrows that I give you are alternative scenarios that are still going to the same place. I'll never give this is never my scenario. Oh, we're gonna break out the highs or break down here, and then jump on whichever one. No, I give you my preferred scenario, and within that, we could go a little higher. Not my preferred, but it would still be objective shorts, and then short up to, but not above. Can break above the trend line. Really, that previous reaction high, you're getting close, and then they're probably going to run into the top of the range. And if they do that, they're probably going to even break it out, whether it proves to be a false breakout or not. If and when that happens, we'll address it. So that's was a really small range. Short. Today's plan. Every day is a new trading plan. That gives you. You could have shorted the pop at the open into resistance or another 0.5% or so higher into here. Let me go back to the futures that I gave you there. That we were just looking at QQQ. This is it. So there it is. Boom. Simple. Doesn't always work out, but you take. I always say you miss 100% of shots not taken, and this is just pre-market dip buyers, Pavlov's dogs, and then I always say, wait till 9:30. That's why a lot of times I'll wait to get these updates out. Wait till the starters step on the playing field. You got a lot of, it's like, spring football, in the pre-market session. You got a lot of amateurs, a lot of, Robin Hood traders and all that buying. And then at 9:30 a.m., boom, liquidity opens up. The market's open. There's a lot more shares traded. And that's when the pros, i.e. the institutions, tend to step on the field. And what they did is they sold that rally today. Not the end of the world, but look where we stopped. These were levels, so we got rejected there. We're highlighted this morning at the resistance at 843. You can active trade if you want. I'm highlighting it and more morphing into, even though we're still in the range, and I told you can certainly, absolutely, still certainly active traders can have a field day trading within a trading range. But if and when we break the range, and again, I just want to be clear, last week, based on the check marks I got, more sectors breaking down, more stocks, key stocks, and the Treasury bonds. I'm going to get to that in a second. Please, 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 let's not forget about Treasuries. I don't mention it in every single update, but I've mentioned it almost at least once a day for the last few months. It is interest rates are everything to this market. And so that kind of ties into my mindset, even if I don't add it to each post. Hey man, as long as we've got IEF down in my orange zone and moving lower, the 10-year Treasury bond yields continue to rise. You want to short rallies into resistance again if that's your thing, or at least you might want to be careful about being in bull mode and buying dips. So it's more of sell the rips. And then, of course, once the trading range goes, there's a bottom of the trading range about 1800, then that should be lights out for the market. Okay, but let's not overthink it. Just trying to thread the needle right now and do what I do, which is highlighting objective entries, long or short. You decide to take them. If you're a bull, now you want to see today's highs, this morning's, post-opening high get taken out. And then you want to see 18,420 get 420-ish taken out. If you're a bear, you get there, you could short. And then, of course, you have the downtrend line. So that's still, this is NQ, that 15-minute chart I got out to you. You can short up to. But in my opinion, I would hold off on shorting on a break above the trend line. Like I said, for the reasons I said, we'll probably go up. And look, if they break it and then they turn around and fail, that's going to be bearish, and then we'll jump in. So again, every day kind of resets the clock as far as active trading plan, whether it's, objective to add rallies into resistance or hold off and wait for a breakout, or maybe even look, if you are short, to start, making sure your trading plan's in place where you're going to stop out or cover those shorts if wrong. But as of now, everything's good. And like I said, this is just the market. So and I'm sure there's others out there, but I am I don't know, I'm trying to find the right word, not a complex trader, but I watch, as you know, a lot of different things that I know for a fact other people don't watch. Some people are just buying the dip on NVDA because they've been wanting to get NVDA, Apple, whatever it is. But in the meantime, and I'll watch those things, but I'm also watching treasuries, and that's a sign when treasury yields continue to rise. It's a sign of non-confirmation on a rally. I guess there's no other simple way to say it, and therefore, again, that means rallies into resistance are likely to get sold into, and breakouts that occur as long as, Treasury yields are pressuring the market, or, should be pressuring the market, then we drop. And then, I'm sorry, then that breakout's likely to fail. All right, let me move on. I already gave you that chart. And again, we're just here. Make no mistake about it. You can step out to a 60-minute chart. This is a 60. Worth noting is we did have a divergence the last time we tested the bottom of the range. There it is, right around 1800. I keep calling it 1800. It says 1804. Yeah, it's 1800. And that's it. This is just swing. This is the larger time. This is a 60-minute chart, so we're stepping out a little longer, and so these divergences tend to give you, there was a divergent high correction, divergent low rally up to this divergent high correction. There was a divergent low at the key support, rally to the top of the range, divergent high down to the bottom of the range. This right here was a divergent low, but so far it only carried us up to the downtrend line, which was highlighted as an objective short entry, so forth and so on. But then this is where this, in my opinion, will stop, and then you start to get just the water lights out for the market, in my opinion. I even mentioned last week, I suspect there's a decent chance the market will crash this week. And when I say crash, it's not going to be like 1929. No, just where, boom, you start just getting that relentless selling, and these shenanigans stop. The dip buyers kind of just get overwhelmed when the stops start getting hit, and then it starts to be a more unidirectional trade where you don't even have to. I'll probably stop posting micro levels at that point, kind of zoom back out to the daily charts and even weekly charts. Speaking of that, all right, so you have the micro levels there. NQ is still what I'm focusing on. If I go over every index on these short-term charts, this video will take forever. That's not the point of this one. Let me just jump over to the weekly chart and reiterate what I've been highlighting recently. To me, big thing again, and this speaks also very much to the mindset of when I'm going to be in short the rip mode, even though, again, for weeks now and months, we're in the sideways trading range. So everyone's like, Randy, you're crazy. We're not in a downtrend. The near-term downtrend, as I showed, the very near-term downtrend for the last couple of weeks is bearish. The intermediate-term trend for the last few months is completely sideways in QQQ. That's that trading range I've talked about. But yet, most folks just see this. Well, we're still in an uptrend. It's just slowed down here. It's consolidating like it was here, and we'll break out and go to new highs. And maybe so. Obviously, you know which way I think we're going. However, I gave you this has been a very fairly reliable enough, and well over 50% success rate, a trend indicator. And it's not only gotten some of the smaller trends, but it's gotten all the big ones in recent years. And you want to be long and strong when that bullish PPO histogram is green, and you want to be short the market or out of your longs when it is red. And again, not all red ones are huge. This isn't an uptrend. It caught that big correction. Again, I'm just updating. We were watching it, anticipating it, got it a few weeks ago. That put the Qs, the most important index, even though the least diversified. It's just, again, it's a zoom in shot, into the market leaders, the same top stocks in the S&P. You just get more clarity because they have a much bigger concentration in QQQ. So again, I don't want to beat a dead horse, but I want to show you something new. So QQQ, we're on week 3. So it's far from a whipsaw yet, even though QQQ is it's not really, going down, since we got the bearish crossover. It's not going up either, but look what joined the, so far. Now, remember, I always say a weekly chart, all that matters is how you close the week. The week is young. So this is interesting. So S&P has been up all day. It opened up big, kind of big-ish, nice up. They faded it like I showed you at the open, and it's been green all day. But yet, look at that. The PPO histogram's red. Well, how's that, Randy? We closed green last week, and we're up, and we haven't even gone red all day. Well, because, again, the PPO is a momentum indicator, and it shows that momentum is slowing. So it's like that analogy I use. You throw a rock in the air. If you put on slow motion, take your camera out and put on that slow-mo video you have on, iPhones, Androids, I'll have it now. You'll see if you throw that rock, it's going to appear to sit and go motionless for a while, as the momentum is slowing. And then it starts to turn and go down, and then it'll accelerate speed till it hits, well, I don't know if it'll hit max velocity before it hits the ground, but either way, it's going to increase. And that's how tops work. Now, again, this could be consolidation. Don't get me wrong. We could go back up just because the momentum indicator slowed. Sometimes they do that, and you look long enough, you'll see cases where they cross and bounce a little. But again, I've covered this in detail lately and all the history of it and how accurate it's been. And there's one great example right here. This is what I was looking for. So nothing is 100%. So if it was, it would be so easy, guys. You'd have a red bar here in the S&P. You could wait till weekly close and then short everything you have, sell all your longs, and sit back and just watch your account go up. Unfortunately, it's not that easy, and that's why I do these videos. There's levels to watch: key stocks, treasury bonds, crude oil, everything I've been covering lately. But there's a good example. We had one bar, and it looked like it was going to cross, and it did cross. We had one weekly close below there, and it was a whipsaw. So that is why I talk about this. But I have to say, as accurate it has been, it's not the be-all, end-all, but it's good enough. Like I said, if I use that Vegas analysis, you go into a casino, every game you're going to sit down at, the odds are against you. If it wasn't, the casino would be out of business, or they wouldn't put that game there. That's why they inserted a red, green 0 and double 0 into the roulette wheel. Otherwise, it was all just the red and black and those odd and even numbers. It would be 50-50 odds. And they'd be spinning the wheel all day. They'd be breaking even over time, but they'd be paying somebody to, sit there and the salary for the person to spin the roulette wheel, and it's not going to be profitable, right? So what I'm getting at is the odds, the probability is in our favor by far that this will play out, and it's not going to play out for just a little quick short-term buy signal, but rather a trend change. And so I just wanted to highlight for you the fact that even though we're green right now, unless the stock market has a good week, it's going to have to go up pretty nice, not just close flat. If it closes flat, we've already crossed. It doesn't matter what happens today, even though it's red today, what happens on Friday. But by the time we get there, if we get my additional sell signals, we're probably going to be way down here. And like I said, I think it'll be, as I've been saying, a pretty swift ride down to the 200-day moving averages, more so than most folks suspect, if we get those final sell signals I'm looking for. And so this is new. That's why I'm covering this. Finally, bearish PPO cross on SPY or the S&P 500, pending a weekly close to confirm it. And IWM, look at that. Last week, small caps, we got one. Remember, a couple up until last week, we only had on QQQ because big tech's rolling over, stalling out first. But now we have all three of the major indexes I like to track and trade. There's others out there. You can play with the Dow, the mid caps. But anyway, check. So where I'm going is, additional check marks. I mean, we had other check marks. We've been short small caps. We broke trend line support. We rallied into resistance. We had that beautiful bearish rising wedge. We fell back in this trading range here. Check. And that's all I'm trying to say. More check marks coming. And not all of them yet. Sometimes you get a lot of check marks. Sometimes it looks like the market's about, or a stock or an index or commodity is about to explode to the upside or drop to the downside. And just when it does, it goes the other way. So I'll do this every day. Today, I got to be light. I have a lot to do. Ran into some big issues on working on the tax return this week. Today's a deadline. I got to get some other things done there before I fire it off. So I'll be not doing a lot of updates unless anything big happens. But I just want to point that out here. Okay, now let's talk about the big thing. And this is why it's like, to me, again, it was a no-brainer to short that rally into resistance today. I don't know if it's just, it feel like, I'm sure others have to be talking about this, but this is my guidebook here. This reminds me, for you baseball fans, you don't even have to be a big baseball fan. A few years ago, if you're familiar with the Houston Astros sign calling scandal, the Astros planted cameras in center field, and they were watching the catchers call the signs out to the pitcher. I don't know, baseball, that's how it works. The catcher tells the pitcher which pitch to throw. And so the team, they're sitting there in real time telling their batters, they would signal them tapping on garbage cans and stuff, which pitch is coming. That's kind of what we have here, guys. So today, this is IEF. There's where we closed Friday. We were down. I was watching Treasury bonds all morning, and I'm seeing stocks rally, and Treasuries are going down. They're going to bounce. They're at support. In fact, I can tell you right now, you can trade a long. I've had that 91.61 support. If you look at my charts now for months, so we just hit support, but yet we were down. Stocks were up. That doesn't work that way. We're getting deeper into my orange zone. Yeah, they're probably going to buy treasuries today because I think stocks will go down because they got ahead of themselves rallying. I also had this level on ZN, the 10-year treasury, 107,288. With another support. This is a support zone down to about 107. You had divergence here last week, but they burned through it on the PPO. Still some RSI divergence. Again, any rallies now, let me say this. So this was, first of all, cue number one. The fact all morning, since last night, Treasury bonds were down, meaning yields were climbing. And it just amazes me that we are. We're kind of like the Astros. We're not cheating. We just have a clear signal. We're seeing by just watching Treasury bonds short the rally. Now, if Treasury bond yields were soaring this morning, I'm sorry, yields were dropping and the bonds were rallying, and it wasn't on any kind of worries, and the stock market was rallying. I know everyone. There's relief that Israel. We'll talk on that in 1 second. Then I would have been a little more less inclined to short or point out that objective short entry with the stock futures rallying right into resistance at the open today. But this confirmed it, and this has been my game plan or a big part of my trading plan for months. I've told you, in the orange yellow zone, the market will start to take yield. This is where it really starts to matter, and we've seen it start to matter. And again, so we're at support. Maybe treasuries will rally, but it depends how. Again, I'll watch that. If stocks start falling hard and treasuries are rallying, that's a flight to safety rally. All right, so, and we're still not there yet, but getting closer to the red zone. Then you've got crude. Crude's down, kind of crude and the stock market, both. This is just, to me, laughable. Last week, I told you before the Iran launched the missile attack on Israel, I saw it on, was it Thursday evening? Buried down, and I'm not kidding. I'll have to find that one for you, that email. It was buried down. It must have been at least the 12th headline down out of 20-something headlines. It was like one of those Barron's or Journal where they give you all the click the links in the email. You get the summary headlines that a Iran attack was likely and imminent, and it wasn't news. And then it started to be news Friday, and that's where the market had that down day. And then it happened. And I am sure you know this. Iran literally launched not one or two. It was in retaliation. The headlines that they think Israel, I don't think took credit, but killed one of their military leaders, an embassy in where was it? I don't know, somewhere, Syria or somewhere. And so it was retaliation. But let me say this. It's been downplayed. The market rallied. Oh my gosh, yeah, the U.S. and their allies and Israel were able to shoot down most of the missiles. Iran or Iran, however you want to say it, launched hundreds of ballistic missiles, drones, and cruise missiles, hundreds, to Israel. That is tantamount to declaring war. That is war. It's not just you kill one of our guys, our little Secret Service is going to try to take out one of yours. They launched hundreds of missiles, and just because we shot them down, all right, okay, market should be no. And so crude oil was dropped. Okay, everything's good because we shot all the missiles down. Hello. Anyways, I'm sorry. That to me is ridiculous. And this is not the Democratic Republic of Congo having a coup or some tribal faction fighting. No, this is the heart of the Middle East. This is Iran and Israel. Okay, so, but the markets just shrugged it off. So what I'm trying to get at, guys, is the risk premium. The market, I think, after Russia invaded Ukraine and there was that reaction, we did have what the markets did in 2022 with natural gas and wheat, and that everybody's just back to business as normal. And so now they're thinking, these global conflicts, it doesn't matter. I think this one could and very much should matter. That's my opinion, and I think the market is grossly discounting what is happening in the Middle East. Hard stop. I'll let you guys figure it out from there. Either way, so crude went down, but remember, crude is also, and crude ran into resistance. I covered that quite a bit last week. Several hits into resistance, but it's still in the orange zone, just like treasuries, meaning it's still very high. It's not far off its multi-year highs. And, and so they sold it down because all those missiles got shot down, and it wasn't a horrible thing for Israel and a huge success for Iran, but it's still what it is. Take it for what it is. And, is it going to be over? Are they just going to hold hands now and sing Kumbaya? Oh, hey, we're even. You got most of our missiles. We wanted to blow up some more of your people and facility, but we'll call it even because we launched 300 friggin' missiles at you and you killed one of our guys. No, I don't know, guys. So whatever. Anyways, watch crude oil. Crude oil is starting to regain some of those losses. And at this point, again, it's just like treasuries. Even if crude goes sideways for a while, the damage is done. And again, there's two components, just like treasuries. I've been telling you lately. There's yields between yields and crude oil prices as well, which is one and the same. You're going to see these track. I've already showed you that. You can trade treasury bonds blindfolded by just trading crude oil because that is inflation, right? That is the key. It's the only real time. It's the biggest component, or one of them, if not the biggest, and it's also the only one that's real time. You can't real time track the housing market. So there it is. If this stays up, it doesn't have to go down from here to be bullish. If it just stays higher, and the longer it stays elevated, just like yields, the more of the impact that's going to have onto the economy, inflation. So there's that. I wanted to cover that. So we'll continue to watch treasuries. I'll try to share my thoughts if when there are rallies, if they're the real deal or whatever. But again, let's keep it simple, guys. There are going to be rallies and bounces along the way, but we're solidly in the orange zone. So unless we start getting back up here into the yellow zone and then the green zone, and assuming that's not due to a flight to safety bid, and you'll know it if you see it. I pointed one out the other day, what they look like and why you can tell, how you can tell it's flight to safety versus just a natural abatement in yields. That's going to be factored in. All right, and I will leave it here with the things that I'm watching. Well, there's a lot, obviously, the sectors. Key sectors of the S&P, yields, the markets themselves. But then the three big stocks that I think to watch this week are Apple. Made a prediction last week. First started with my mea culpa that I missed that beautiful breakout. I just had a price alert initially on Apple when it first broke out, triggered, and then that was a whipsaw, and I never reset the alert. This was the trend line. I added this one last week. I'm even going to take it away because we went through it. This was the one I had before. This was the primary trend line. And again, whatever. Can't catch them all. Missed that. And it was just a textbook. Beautiful. This is my kind of setup. Add support, and shame on me for missing it. But again, that was then. This is now. I'm going to certainly miss a lot more going forward. Nobody can catch everything. Not even the machines. Anyway, it broke out. Went up to that 176.15. So far, we're still above the breakout. I predicted that there's a good chance that breakout will fail. If it does, it will be probably the single most bearish event I could see happen this year. Probably even as much or more than QQQ breaking 433. Because this, again, why? Well, number one, it's a textbook breakout. This is a crowd favorite. Might not be the crowd favorite just in recent months with NVDA taking that lead, but Apple, we're talking decades. It's like your favorite team or favorite professional athlete that might have a tremendous track record along, has a couple bad season or a few bad games. Apple's still Apple, guys. Everybody loves Apple. And so this breakout, by every account, should rally. But I told you the reasons why I think it has a good chance of failing, including but not limited to the current posture of the PPO below that zero line. And I often say fewer things in trading are more bearish than a failed breakout. So watch for that. And again, the same levels I was highlighting here, where the last time I was bullish, did catch that breakout. We were long. Pre-break off the support, if I'm not mistaken. That support, if it was important to me back then, it's that much more important now. So there it is. There's your magic number. It's just lights out. There's just for the market. If Apple does that, it'll just be. We'll be in kind of in that hard down mode, I believe, in the market. So, and it hasn't happened yet. So something to watch, and that's why I go over these things. Try to highlight them in advance, not after the fact, because if Apple takes that out, it's going to probably be too late for you to get on board the short train. So you want to watch it and get in front of it, or as it's happening in real time. Tesla, like I said, same setup. It's at support. You can see the support's not as well defined, but you can see we have a lot of reactions there, major low there. So there's a big support range it's at. Beautiful downtrend line. It tried to pop it once, it couldn't follow through. It also has, like Apple, positive divergence at that most recent low. If it makes a new low, it will. But again, they're just not buying. And this one's got fundamental problems. I'm sure you read about it. Now they just halted production on that Tesla truck, which has just been a dud from what I hear anyways. Anywho, so there's another former Mag 7 that's certainly former crowd favorite. I mean, this couple years ago was NVIDIA. It was a crowd favorite. Everybody loved Tesla back here. It was the hype. Elon Musk was brilliant. Tesla's going to go to the moon. They're going to rule the world, blah, 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 blah. And you can see that was the kiss of death on Tesla. And so watch it. Watch it for failure for these bullish divergences to play out. And the most bearish thing would be if they take out the divergence. Let me show you a good example. It was one I highlighted. I told you at the time I wasn't crazy about it, but threw it out to you because we had positive divergence on Intel. The former king of semis, long since gave that title up to NVIDIA. But you had positive divergence. You are at first price support, then the 200-day moving averages just below, and then the trend line. Boom, 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 boom. One after another taken out, divergence gone. That is what... To me, those are things I only see in bear markets, not bull markets. When you have a textbook bullish setup, but yet it just fails to materialize, it means the supply-demand dynamics have shift. There's no buyers sitting behind the other side of it, and they should have bought in. They should have bought it there, and it just keeps going down. The divergences are gone. Will it bounce soon? Yeah, it's oversold. Last time it's been this oversold was all the way back here. So... talking it's below the 70 level, or just was on the RSI, and it hasn't been below there since right here. So, hey, that was a great time to buy. We were buying, we were buying it right here. We were buying it on that second tag there. We might have been buying it on this one too. Yeah, we had positive divergence there. This time around, we don't have the divergence anymore. So, like I said, this is just something that I wanted to point in with Apple, that textbook bullish setup, that recent breakout. Again, it hasn't failed. That's my guess, my prediction that it will. But unless it does, Apple may hold the market up. So watch Apple. And then the other one, of course, the big one, the most important stock right now is NVIDIA. And it still needs to break that 840 level. So the recent lows set a price alert. So I like to say support is support unless broken. So... like QQQ, like the market, it's been consolidating. It's in a range. Top of that range, which would be bullish if it takes it out, unless it fails, is about 970. So let me give you that purple box. This is, it's just like QQQ. So there it is. And so at the end of the day, and I know in the past couple of weeks, there's been a lot of frustrating, almost outright angry comments about, how can you be bearish? The market's in bull trends going up. The market, again, hasn't gone up for months now. It's been going sideways. The leading stocks have. And again, when you peer in a little deeper, that's what I do. That's why I do these long-winded videos. We're getting sell signal after sell signal. I have a whole series of check boxes, including the top stocks, which are mostly holding up. I will give it that. Well, I'm sorry. Apple, done. Tesla, done. We just need the rest of the lot to roll over, mainly this guy. I think this guy single-handedly, NVIDIA, if and when it breaks down, and I think it will, based on the divergences, the rest will just crumble with it. Because this is the king of AI. So if this dies, what's been boosting Alphabet, because Alphabet went all in, Google went all in on AI. They were surprised, caught off guard that Microsoft had that stake in ChatGPT, and boom, and so they... oh no, we got to shift plans. And then the breakout in Apple the other day, even though it was technical induced, coincided with some mutterance of AI, using more AI. Apple obviously was and Apple's usually that way. They sit back. I've followed Apple and the Apple, iPhone, Android whole thing for years. Android always typically is the forefront, invents the little features and things and the flip phones, and then Apple sits back and waits, and that's what they've always been good at. And Jobs even said it. Steve Jobs once was quoted saying, "I never invented anything. I just take an idea and make it better." He started with saw the Walkman, and then he made the iPod. That kind of put him on the map. He didn't invent the cell phone. The cell phone was there. He just made it better. And so Apple's that's typically their thing. But lately they tried to be innovators, and with the self-driving cars that flopped, and they're and it's reflected in the stock. They've kind of not they're kind of directionless and not innovating in the little projects they've tried to go into. That headset and all that stuff, that stuff's flopping lately. Anyways, watch the stock. I'm just kind of talking fundamentally what's going on there, and I'll just leave it at this. One thing I wanted to cover, loop back to IWM. This is a daily chart. You can look at a 60-minute chart too. You can see every all the divergences, the last recent divergent high, trend line break. But the simple thing, again, this is, I'm going to turn off all the lines, and it's kind of a no-brainer here. You go to edit chart properties, compare it. I'm talking about the Treasury bond trade. So small caps of all stocks, they're much more sensitive, as I've talked about many times in the past, much more sensitive to interest rates because they're more dependent. Apple, like I said, borrows money, sells bonds, or has in the last a few years. They didn't used to. They never needed. They were, always have been for decades, cash flush, still are, but they sold bonds only because they could, because the Fed's easy money policies let them sell bonds, borrow money at almost an extremely low cost of capital, where they could turn around and buy their stock. But the small caps, unlike the large caps, they are absolutely dependent on borrowing, very much so. And this is just a no-brainer. What I did here, I clicked on IEF, the 10-year Treasury bond. Remember, when the bond's going down, yields are going up. Again, if you can't see that correlation there between the Treasury bond yields and small caps, and what you see lately is Treasury yields have been moving up at an increasing rate. This is an increasing downward slope. Sometimes yields are going up. Small caps are relative. They're going down. They're tracking. You can see they're almost perfectly. You can, again, blindfold me and I will trade IWM if I can only look at the chart of IEF. And so what I'm saying is these divergences, this move down in Treasury yields, has not been fully reflected in either IWM, I think, or the stock market. So I'll continue to watch it closely. I mean, they can turn around. I showed you it's at support today, but I can't make a strong case for a rally. I do think yields are still going to continue higher. And at some point, the stock market, it hasn't gotten the memo yet. The stock market as a whole. That's why we're still in that trading range. And that's it, guys. You have everything to watch, how to trade it, those correlations there. It's not super hard. You're talking, if you want to watch, 3 or 4 things, watch QQQ, those levels I gave you, watch Treasury yields, crude oil, and maybe NVDA, and those alone, and Apple. If that breakout in Apple fails, again, it will be a knife through the heart of the bulls. But hey, a breakout is a breakout unless it fails. So, maybe not, it's not that all-in moment yet. I've told you I'm pretty aggressive short, but I'm an aggressive trader. So generally speaking, if you want to put the odds in your favor, just wait. We're not far from 433 on QQQ. There it is. We're getting close to the bottom of the range. Again, that's kind of the safer bet. The only time you're going to regret doing that is if we start heading down there and then one day we just gap down big. Let's just say there's something, boom, some Israel then now retaliates on Iran, and it's not good. And then other countries get involved. It could be a proverbial shit show over there. All right, guys, I'm going to wrap up here, get the video out to you. I'll do what I can to do updates today. At the very least, I'll get one out to you at the end of the day. You have the levels to watch, and that's it. And the key things to watch. I'll pick it up later. This has been Randy Finney with Right Side of the Chart. Have a great day.